Hey everyone, welcome back to Wealth for You, where we make investing simple, sensible, and just a little bit fun. So, DBS just dropped its second quarter results this morning, 7th August 2025, and it's huge. They're paying out 75 cents per share in dividends this quarter alone. But with interest rates falling and the global tax rules kicking in, is DBS still a reliable dividend giant? If you're serious about growing your copy money while you sleep or want to know whether to buy more DBS or hold, this video breaks it all down, in plain English. We'll talk about what DBS actually does, what the latest results mean for your portfolio, and whether its 6% plus dividend yield is still sustainable. So stay till the end, especially if you hold DBS stock or are thinking of buying. Give this video a like so more Singaporeans can discover it, and subscribe to Wealth for You for more friendly investing insights every week. Just a quick disclaimer. This video is for education and entertainment only. It's not financial advice. Always do your own research or speak to a licensed advisor. Let's dive in. Chapter 1. Why Dividend Investing? Let's start with the basics. Dividend investing is when you buy stocks that pay you regular cash payments, like a mini bonus from a company you own. It's a favorite strategy for Singapore investors because it gives passive income. You don't have to sell shares to get cash, and in DBS's case, the payouts are generous and stable. Chapter 2. What does DBS actually do? Now, when most people think of DBS, they picture the familiar red logo next to the MRT, or the polite staff helping you print your bank statements. But behind those branches is a regional financial powerhouse. DBS is not only Singapore's largest bank, it's also one of the top banking giants in Asia, with a presence from Hong Kong to India and even offices in London and New York. So how does DBS actually make money? Well, think of DBS as a giant financial engine with multiple income streams. They lend money to people and companies and charge interest. They manage wealth for high-net-worth clients, helping rich people get even richer. They help businesses raise funds, do IPOs, and handle big financial deals. And of course, they make money from banking services and transaction fees. Yes, even when you withdraw cash or transfer funds. But here's the cool part. DBS isn't just resting on its old-school bank image. They're leading Asia's charge into the digital future. They run a digital asset exchange. They've issued tokenized deposits, and they're even working with stablecoins and central bank digital currencies, or CBDCs. This is not your grandfather's bank anymore. It's more like a tech company with a banking license. So when you invest in DBS, you're not just buying into a traditional bank. You're also getting exposure to Asia's growth, digital innovation, and solid income potential all in one. Chapter 3. The Big Reveal. All right, let's get to the juicy stuff. The numbers that just dropped this morning, hot off the press. While most of us were sipping kopi, DBS quietly revealed its second quarter results for 2025, ended on 30th June 2025, and here's the headline. Net profit came in at 2.82 billion Singapore dollars. That's 1% higher than last year, which might not sound like fireworks, but given the headwinds, it's actually very impressive. Despite interest rates falling and new global taxes eating into earnings, DBS still delivered a solid 17% return on equity. That's like earning 17 cents back for every dollar of shareholder capital, a number most companies would love to have on their report card. But here's what really stood out. Wealth management fees shot up by 25% compared to last year. Why? Because more people are trusting DBS with their investments, and more money is flowing into DBS's care. Markets trading income? Best in the last 13 quarters. That's over 3 years. Their treasury and trading teams clearly brought their A-game. On the balance sheet side, loans and deposits are still growing steadily, especially in Hong Kong and Southeast Asia, where economic momentum is building. And if you're worried about bad loans or credit issues, don't be. DBS's non-performing loan ratio actually improved to just 1%. Translation: their lending book is strong and well managed. Nothing fishy under the hood. So in short, DBS didn't just survive a tough quarter with lower interest income. They flexed their muscles in non-interest income, proving they're not just a one-trick pony relying on loan margins. They're running a well-oiled, diversified machine, and these results show it's firing on all cylinders. Chapter 4. Dividends, baby. Now let's talk about what Singapore investors truly love. Dividends la. Because let's be real, when you buy a stock like DBS, you're not just looking for capital gains. You're looking for that steady, reliable Kopi money that flows into your bank account every quarter without you lifting a finger. And DBS definitely delivered this quarter. For the second quarter of 2025, they announced not just one, but two payouts. First, a 60-cent regular dividend, same as last quarter. Then, a 15-cent special dividend as part of their capital return plan. That's a total of 75 cents per share, just for this quarter alone. If you're holding 1,000 shares, that's a nice $750 dropping into your account. No effort needed. And here are the key dates to remember. The ex-dividend date is the 14th of August 2025, so make sure you buy before that if you want the payout. The dividend will be paid on the 25th of August 2025, just in time for your next long weekend. Now let's take a step back and look at the big picture. In 2024, DBS paid shareholders $2.16 per share. That's already solid. But if they keep this current pace in 2025, we're on track to receive over $2.40 per share, which would be one of their highest payouts ever. That gives us a trailing dividend yield of about 4.97%, based on the current share price. And if you're looking ahead, the forward yield is closer to 6.1 to 6.2%. That's higher than some REITs today. Even better? DBS has kept their payout ratio at a healthy 56%, which means they're keeping nearly half of their profits to reinvest in the business while still rewarding shareholders generously. And they've got the track record to back it up. Dividends have been growing steadily over the years. Plus, with billions in earnings, strong capital buffers, and a very disciplined management team, these payouts look very sustainable moving forward. So for income investors who want peace of mind and consistency, DBS is acting like the kind of dependable dividend machine you'd want in your long-term portfolio. Chapter 5. Is DBS undervalued or overvalued? Alright, so the business looks strong, the dividends are flowing. But here's the golden question. Are you overpaying if you buy DBS now? Or is there still value on the table? Let's look at the big picture. As of today, DBS has a market cap of around $137 billion, easily the heavyweight champ of the Singapore stock market. It's trading at a price-to-earnings ratio of roughly 12.3 times. That means for every dollar of profit DBS makes, investors are paying $12.30. Now, that's not cheap, but it's certainly not expensive either, especially for a bank that's delivering 17% return on equity. And don't forget, we're talking about one of the most profitable banks in the region. On the price-to-book ratio, DBS is sitting around 2 times, which means you're paying twice the book value of its assets. A premium, yes, but a reasonable one for a blue-chip dividend powerhouse with consistent earnings. Now let's put it into perspective. A 6% plus dividend yield, backed by strong profits and low risk? Even the more popular REITs in Singapore aren't giving you that right now. And many of those come with higher debt and more exposure to falling property values. DBS, on the other hand, is still growing, expanding across Asia, and has the firepower to return capital while investing in future growth. So here's the verdict. If interest rates continue to fall, and they likely will with the Fed hinting at cuts. DBS's current valuation could actually look cheap in hindsight, because bond yields will drop and more investors will hunt for reliable dividend plays like this one. In other words, you're getting a high-quality business at a fair price with a built-in income stream. Not screaming cheap, but definitely not overpriced. If you're a long-term income investor, DBS looks like a solid value buy, or at the very least, a stock to hold tightly and never let go. Chapter 6. A critical look at DBS. All right, let's take off the rose-tinted glasses for a moment. Yes, DBS delivered a strong quarter, and yes, the dividends are juicy. But like any investment, we've got to be honest about the potential risks. Let's start with what's not so rosy. First off, net interest margin, or NIM, is slipping. That's the difference between what the bank earns from loans versus what it pays on deposits. And in the second quarter, that margin dropped to 2.55%, mainly because interest rates are falling globally. If this trend continues, it could slowly chip away at DBS's interest income. Second, institutional banking income took a dip, especially in areas like cash management. This usually happens when big corporate clients move money out of low-yielding products or hold back on activity during uncertain times. Third, DBS has become more reliant on wealth management fees. Now, that's great when markets are calm or going up, but if there's a sudden downturn or correction, those fees could shrink fast, and that would affect non-interest income. And finally, let's not forget the new global minimum tax rules. These have already started to bite into net profits from Singapore operations, and will continue to be a drag on future earnings. But before you panic, here's the good news. DBS is not putting all its eggs in one basket. Fee income is coming from multiple sources: trading, treasury, loans, not just wealth management. The bank's capital position is rock solid, with a CET1 ratio of 15.1%. That's well above the minimum required, and it gives DBS a strong buffer against shocks. Credit quality remains excellent. The non-performing loan ratio is just 1%, which means their borrowers are largely safe and stable. And perhaps most exciting, DBS is pushing ahead with digital innovation. From tokenized deposits to stablecoins, they're not just reacting to the future, they're shaping it. So yes, there are risks, especially as the world prepares for rate cuts and global tax changes. But DBS isn't sitting still. It's adapting, diversifying, and still generating billions in profit along the way. Chapter 7. What's next for DBS? So, after all that, here's the big question on every investor's mind. What happens next, especially if the U.S. Federal Reserve starts cutting rates again? Because let's face it, when rates go down, banks usually make less from lending. And yes, that will likely put pressure on DBS's net interest margins in the coming quarters. But here's the thing. DBS isn't sitting around waiting to be squeezed. They're already planning several moves ahead. First, they've hedged their balance sheet. This means they've put strategies in place to soften the blow from falling interest rates. Think of it like insurance for their loan book. Second, they're doubling down on wealth management. As more investors in Asia grow wealthier, DBS is positioning itself as the go-to bank for private banking, investing, and financial advice. This income isn't as rate-sensitive, and it brings in strong recurring fees. Third, they're expanding into fast-growing Asian markets like Indonesia, India, and Hong Kong. These economies are on the rise, and DBS is right there, building their footprint and capturing new customers. On the deposit front, DBS is growing its CASA base, current and savings accounts. These are low-cost funds, which help maintain healthy margins even when lending rates dip. And don't forget, they're also keeping expenses under control, so every dollar earned goes further. So yes, the global environment may be shifting, but DBS is showing that it can pivot, protect its margins, and grow beyond Singapore. They're not just preparing for rate cuts, they're positioning for the next phase of opportunity in Asia. Chapter 8. Buy or Hold. Alright, time for the big question. Should you buy DBS now, or just hold on to what you have? Let's recap what we've uncovered so far. You've got a bank that's generating billions in profit every quarter, paying out reliable, growing dividends, now over 6% forward yield, maintaining a strong balance sheet, even with falling interest rates, and expanding into fast-growing Asian markets with long-term upside. Plus, they're not just defending their position, they're innovating fast, from digital wealth platforms to blockchain-based financial infrastructure. So if you're the kind of investor who's looking for passive income that feels like clockwork, a resilient, homegrown Singapore bank with global reach, exposure to Asia's growth story without venturing into risky territories, and a defensive dividend stock that can ride out the ups and downs of this crazy market, then honestly, DBS is a solid buy. You're not just investing in a stock. You're buying a piece of one of Asia's most trusted financial institutions, with a dividend you can count on. And if you already hold DBS? Well done. You've got yourself a cornerstone in your portfolio. Definitely hold. And if the price dips on short-term noise, that might just be your signal to top up and enjoy even better yield. As always, don't chase hype. But when you see quality plus consistency plus income, that's the kind of investment that builds long-term wealth, quietly but powerfully. Final thoughts. And that's it for today's update on DBS's second quarter 2025 performance. Now I'd love to hear from you. Are you adding more DBS to your portfolio? Or do you have your eyes on another juicy dividend stock? Let's chat in the comments below. I read every one. And hey, if you found this video helpful or it gave you some clarity on your investing journey, please give it a thumbs up. It really helps push this out to more Singaporeans who want to grow their passive income too. Subscribe to Wealth for You and hit the bell so you won't miss the next dividend stock breakdown. And remember, don't just be rich, be cash flow rich. Take care, invest wisely, and I'll see you in the next video.